Welcome back to our class. In the previous study, we have learned the profit model and process of LBOs. In LBOs, financial sponsors contribute equity and borrow a significant amount of debt to finance an acquisition of a target. After an acquisition, financial sponsors will try to improve the profit margins of the target, and the operating cash flow of the target will be used to pay down debt, which is called deleverage. And the value of shareholders' equity increases in the deleveraging process. Later, the financial sponsors will try to exit or monetize their investment at a profit. In a typical LBO process, key participants include private equity firms, private equity investors, bond investors, and institutional lenders, as well as investment banks. In this video, we will have a more detailed review on the participants in LBOs. A vast majority of financial sponsors are private equity firms. The financial sponsors are equity contributors, and they are also in charge of the whole LBO. Before an acquisition, the sponsors need to select an LBO target. This process requires profound understanding of specific industries and markets, and a lot of due diligence efforts are necessary. After identifying a target, the sponsors need to negotiate the acquisition price and terms with the target. They are also responsible for securing debt financing. Investment banking division of an investment bank would often help with the acquisition process. After the completion of an acquisition, the financial sponsors become owners of the target. They have control of the board of directors. They oversee company management and actively operate the acquired company. It is their responsibility to make major strategic and financial decisions of the target. The goal is to boost the profit margin of the target, because the cash-generating power of the target influences its ability to pay down debt as well as its market value at the time of exit. The sponsors also decide when and how to monetize the target. An investment bank would also help with the last process. The ultimate job of financial sponsors is to generate a good return for their investors. Private equity investors include institutional investors and high net worth investors. As opposed to directly investing in the target equity, the investors passively invest by participating in a fund organized by the private equity firm. This fund would be organized in the form of a partnership. The private equity firm acts as general partner and is in charge of the management. The investors act as limited partners in the fund. The investors commit capital to the partnership by subscribing a specific portion of the total fund's capital. These funds are often blind pools, and the investors have no knowledge about the investment plans at the time of subscription. The general partner would draw on the capital when an investment opportunity is available. Because private equity investments are typically long-term in nature, the limited partners would sign an investment contract to lock up their money. But investors can receive money back as soon as the investment is monetized. Next, an LBO always needs a significant amount of debt. Debt can be contributed by bond market investors as well as institutional lenders. In the bond market, investment banks help underwrite the bonds to the capital market. Bonds issued by LBO targets are largely considered long investment grade. Investors of leveraged bonds are generally institutional ones, such as hedge fund, high-yield bond mutual fund, and structured debt vehicles, such as CDOs. The debts can also be privately provided by institutional lenders, such as commercial banks, investment banks, funds, and investment companies. Sometimes the sponsors need to borrow an interim loan called bridge loans to finance an acquisition before permanent debts can be obtained. Bridge loans are particularly important for LBO financings because the sponsors need to provide certainty of funding to the seller. Bridge loans are typically more expensive than permanent financing because it provides immediate cash with minimal paperwork. But there are also risks associated with financing bridge. For example, the sponsors may not be able to secure long-term debt to replace the bridge. In LBOs, banks would form lending syndicates to mitigate the risks of financing bridges. Investment banks also play a key role in LBOs. First, they can introduce potential acquisition targets to the sponsors. They also provide advisory service during the merger process. They provide loans and also provide underwriting services in high-yield bond offering. They also assist in the eventual sale of the target company. Last, the management of the target may also play a key role in an LBO. There is a special type of LBO led by the management team of the target. This type of LBO is called management buyout, or MBO. The target of an LBO is typically a public company. The management of the target approaches a financial sponsor to buy the target, after which the public target will be privatized. The sponsors provide capital support and also help to access debt financing. But why would the management prefer going private? A basic reason is that the management believes the target is undervalued by the market, or the company can operate more efficiently as a private company. In an MBO, the management would typically hold a meaningful amount of stakes in the target after acquisition, which aligns their interest with the operating performance of the target. This also links the interests of the management and the financial sponsors. Okay, in this video, we have discussed the key participants in LBOs. Thanks for watching. In the next week, we will move on to the next chapter on sell-side M&As and corporate restructurings.